Well, hello. It's your boy, Chuck Boomberg, back in the house, baby. Y'all sick of me yet? I bet some of y'all are so sick of me. Happy Sunday. It's Sunday, September 7th.
Boomberg on the track.
So, look, let's get to it. Everybody on TV popping champagne because the market sky high, baby. But they ain't hearing the ghost in the machine. History is talking. Or better yet, it's fucking screaming, if you ask me. Because I hear it loud and clear. And I hope a lot of you do too. But you probably don't. We've seen this movie before. The money printer goes, like a machine gun. Cutting rates, making everything look pretty. It ain't pretty. It's not fucking pretty at all. It's a fucking setup. This is for the biggest bubble burst we ever seen. And I'm going to show you the 3 big cracks in the game that prove the big one is coming or is already here. See, the clues are everywhere if you know how to read the tea leaves. I bet a lot of you don't. By some counts, the U.S. stock market is more expensive right now than it was when the dot-com bubble peaked back in the year 2000. It's 25 years ago. But the real world, the streets, Main Street, not Wall Street, Main Street, they're hurting. The jobs machine is running on fumes, adding a measly 22,000 jobs in August of this year, 2025. And the average job growth has slowed way down from a year ago. But this isn't a slowdown. This ain't no slowdown. It's a warning shot. They're brewing the perfect storm, cutting interest rates to paint over the rust. While all the assets are stretched out like a rubber band about to snap you in the fucking eye. This is the grand finale of a long party on borrowed time that we've been on, right? The age of easy money and all that. The everything bubble, or what I like to call the big, beautiful bubble that's about to burst in everybody's face. Stocks, bonds, crypto, even the dollar itself is at a limit. Stick with me, the bag brigade, because what I'm about to lay out is the blueprint for what's next. See, the problem, it echoes. It's echoes of history. You can call it that. So how do we even get to this point in the first place? I mean, seriously, right? It's simple. You got to understand the rhythm, the cycles, like the rhythm, the rebel. Economies, markets, shit, even whole fucking empires, they all move in waves like a surfer. What we're living through, it's nothing fucking new. It's history rhyming. It's a beat we've heard right before every other time the whole thing came crashing down. Think back to the late 90s. If some of you were even alive back then or know what I'm talking about. I was. The story was the internet changes everything. That hype fueled a crazy fever in tech stocks, pushing numbers that made fucking 0 sense, right? Today, the new drug is AI. But we all know that, right? Artificial intelligence. We all use it. It's going to dumb down the next generation to the next generation till the human race is so fucking stupid because they never have to think for themselves. They just ask a goddamn computer model, a learning language model. And just like back then, though, the whole market is getting shoved into a few mega tech names. In fact, it's even more top heavy now than during the dot-com days. Some analysts, which I don't really, most analysts, in my opinion, are fucking stupid. But some analysts are saying that the top stocks, the Mag 7, the MAGA 7, whatever, make up almost 40% of the S&P 500. Think about that. 7 stocks. S&P 500 has 500 stocks in it. Out of 500, only 7 of them is 40% of the movement, when it was just 27% at the dot-com peak. It's a 13% difference. But that ain't a healthy market. That's a house of cards waiting for a stiff wind. Just to go puff and pluff and blow your house the fuck down. The tools they use to check the market's temperature are all flashing code red, code red, code red. The price to sale ratio for the S&P 500 is up there past the peak of the dot-com era, meaning people are paying more for every dollar a company makes than ever before. The Buffett Indicator, which squares up the whole market value against the economy's GDP, has also blown past levels we saw in 2000. Now, a lot of cats are going to say, this time is different. This time is different because the AI and this and but that. Shut the fuck up. This time is not different. Because today's tech giants actually make money. But that ain't the point. A bubble ain't just about profits. It's about price and psychology. And right now, the price is unhooked from reality, floating on a cloud of hype that history always, and when I say always, I mean always, fucking brings back down to earth in a very hard, slamming manner. Some smart people are drawing lines, not just to '08 or 2000, but way back to 1937, a time of sharky economic and bad calls that led to a deep freeze. In 2025, just like in 1937, we're seeing money get tight to fight inflation, which slows things down. While countries are putting up walls with trade policies, breaking up the global flow, this combo of a top heavy, overpriced market and a world economy that's catching a cold is the classic recipe for a crisis. Okay. The echo is deafening. Literally. Hurts my fucking ears. But most people got their headphones on, just like me. But I can hear right through these. The problem is clear. We're on the edge of a bubble so big, so wide, that when it goes, it's going to be like nothing we've ever seen. Now, let's talk about the gasoline and the oil or whatever. The one thing throwing fuel on this fire is central banks, the Fed. For a couple years, they were talking tough, fighting inflation, jacking up interest rates. That was the tightening part of the song. But now, with the economy getting weak in the knees, they're doing what they always do. They're switching up, pivoting, as most people like to say. Wall Street is betting the farm on an interest rate cut this month, September of 2025, with some seeing the odds as nearly a sure thing. Why? Because they can't ignore the numbers anymore? That August job report was a disaster? Like I said it was going to be? Wait till the revisions drop on Tuesday, people. Showing the economy barely added any jobs, a huge miss from what they expected. The unemployment rate has crept up to around 4.3%, the highest it's been in a few years. The labor market, the engine they said was so fucking tough, is sputtering and stalling out. This is a trap, if you haven't figured it out. It's a trap. It's a classic. First, they print a bunch of easy money that causes inflation. Then they tighten up to fight the same inflation. And that breaks something in the real world or the economy. This time, it's the job market, but there's other things. But the job market's pretty, it's what we're focusing on right now, at least. Then they panic, looking at a recession. They flip the script and start cutting rates all over again. That's where the real danger is. Why? Well, Wall Street is cheering for these rate cuts, calling it a relief rally. A relief rally? I mean, geez, if I go on a monthly chart of SPY, please tell me, anybody, these are monthly candles. There's the bottom of '08 or '09. That thing has gone straight up. So I don't know what relief rally these people are talking about. Been on the biggest bull run since ever, in my opinion. I mean, I don't know. It's absolutely absurd. But yeah, the jobs market, anyway, sorry. See, again, that's where the danger's at. Like this relief rally. They think cheaper money is going to pump up stock prices and save the day. Well, that's an illusion. Is that the illusion of wealth or whatever? I did that video. It's like a magic trick. Cutting rates when asset prices are already in the stratosphere is like trying to put out a grease fire with water. It doesn't fix the fucking problem. It causes a goddamn explosion. These cuts are going to be the siren's song, pulling investors into taking even dumber risks in the last craziest phase of this bubble. It's a tale as old as time. When the Fed cuts rates and the economy is still kind of strong, the market can fly. But when they cut rates because the economy is actively falling apart, that's one of the worst setups you can have. And that's where we are. Whether you want to believe it or not, it depends on what news you're following and care to listen to, or if you're, like I said, 90%, 95% of the world population is either ignorant, stupid, or dumb. Why? Because they choose to not do their own fucking research and they just listen to what they are told on the fucking news, and that's their opinion. It's ridiculous. Get with the fucking program. Anyways, the Fed is not in control. This is all just a reaction. Trapped in a loop, it made itself. Their moves made the inflation. Their reaction is cracking the economy. And their next move, the cuts, is going to be the trigger that sends this whole thing into a spectacular, ugly, blow off top. They ain't firefighters, people. They are arsonists showing up with a house of fucking kerosene. There is a crack in the system, and it's a system on the brinks. Okay. All right. So if history is the map and the Fed cuts are the gas, then the deep cracks showing up everywhere are the groans of a building about to fall, like the office market here in the United States and globally. These ain't little cracks in the paint. These are fractures in the fucking foundation. Let's start at the heart of it all, the US Treasury bond market. For my whole life, Treasury bonds were the safest bet on the planet, and probably for most people that are, millennials or older, I guess. Not anymore, though. The market's getting spooked. Investors are now demanding a higher term premium. That's extra cash to cover the risk of holding long-term U.S. debt. Bonds. That premium has shot up to its highest level in over a decade. Why? Because they see the U.S. government swimming in debt with trillions more on the way. I mean, we legitimately spend $1 billion on interest payments on our debt alone every single fucking day that goes by. That's absurd. We can't get out of that. How? Does it? People are starting to think the U.S. credit card is maxed out, right? I mean, because it's beyond maxed out. It's like they found a way to keep using it. Well, this got even worse after Fitch, one of the big rating agency companies or whatever, downgraded the U.S. debt back in 2023. It really didn't do much to the market back then. I mean, I remember that. I mean, but the bedrock of the whole financial world is starting to look like it's got feet of clay, just smudging around down there. Then you got the US dollar, right? The king. Yeah, the king. It gets strong when the world is scared. But its crown is cracked too. That's the problem. The first half of 2025 saw the dollar have one of the worst runs in over 50 years, dragged down by wild trade policies and worries about all that debt. Now, the dollar ain't going to disappear overnight, that's for sure. But it's undisputed reign that we've had, basically, you know, since World War II or even before. It's fading. Analysts are calling for it to fall even further as the world looks for other places to park its cash. The dollar is like in a tug of war between being a safe house and the reality of the house that's fallen apart. That's the unfortunate thing, and that is true. And of course, we got to talk about stock, right? Like I said, the S&P 500 is being held up by a few big body tech stocks. Narrow parade is hiding a weak army behind it. If you look at the S&P 500 on an equal weight basis, like I was just saying earlier, where every company counts the same, the picture looks a lot flatter. That tells you the headlines are an illusion, a mirage created by a handful of fucking giants. That's a classic sign of a party that's about to end. When the generals are charging way ahead, but the soldiers are retreating, you know the battle about to be lost, fam. And finally, you got crypto. The canary in the coal mine speculation, all right? The crypto market in 2025 has been a wild scene with tokens flying high on nothing but Twitter hype or X, whatever, formerly known as Twitter. This is the same pattern as every other bubble where fast money is followed by a fast crash. Analysts see technical signs that often come before a big drop, with some saying a collapse would wipe out trillions. Crypto is like the market on steroids, driven by the same cheap money and fever dream sentiment. Its wild swings ain't a separate story. They're the loudest symptoms of a sickness infecting the entire fucking system. These cracks in the bonds, the dollar, stocks, crypto, they ain't separate problems. That's the thing. They're all connected and all feeding each other. A crisis in bonds could send interest rates flying, crushing the stock market. As I've said before, they will crash the stock market to save the bond market if they have to. A falling dollar could bring back inflation, following or forcing the Fed's hand again. And a crypto crash could start a fire sale on all this shit because of the fear that burns everything else down with it. The system is fragile, man, and the cracks are just getting wider. And look, I get it. This is heavy. I mean, there's a lot to take in, right? What do? I'm not here to scare you. I'm here to fucking prepare you. See, seeing the game for what it is, that's the first step to playing it right. If you're getting something from this breakdown and you want to stay ahead of what they're selling you on TV, do me a fucking favor. Hit that subscribe button, ring the bell, like the video, share it, whatever. And don't miss what's next. I'm here to give you the real, the raw, the unfiltered, and the motherfucking truth. Straight up. That's what I do. You dig? So the $1 billion question is what now? Well, it's easy to get shook up. But panic is a trap. It leads to bad moves. The answer ain't to run and hide. It's to watch, to learn, and to be fucking ready. This ain't financial advice, okay? By all means, this isn't. But this is me telling you what signals to watch for. These are the final tremors before the earthquake comes and wrecks us all, right? First, keep your eyes locked on the labor market numbers. Don't listen to the headlines. Read the fucking fine print. That weak job growth of only 22,000 in August that we had just recently is a huge red flag. Watch for more weakness. Watch these revisions on Tuesday, especially when they revise the numbers from the past month, when they keep revising numbers down like they have been for the past 3 years now, I want to say. I don't even know. Like it means the situation was even worse than they told you at first. Also, keep the weekly jobless claims. Keep an eye on that. Always. It's like every Thursday, I believe. If that number keeps climbing, that's a classic recession signal. Period, plain and simple. The job market holds up the American consumer, and when that leg breaks, the whole table flips. You dig? Second, watch the fucking bonds, the bond market, especially the yield curve. There's there's a lot of yield curves. There's the 10-year minus 2-year, and there's a 10-year minus 3-month, which is, in my opinion, the more important one. But if you don't know about that, it's fine. Some of you may be new here, but I have preached it in the Bagwegate Discord community for years at this point. The curve gets steeper, where long-term interest rates rise faster than short-term rates. That's a bad omen in this environment. It means investors are demanding more money for the growing risk of inflation and government debt, even while the Fed is planning to cut short-term rates. It's a sign of a huge conflict in the market, a loss of faith in long-term plans, basically saying that people don't believe that America is going to survive, in a sense, in the long term. That's really what they're saying. It's a shift, a global shift. Keep a close eye on the 10-year Treasury yield. Ticker sign TNX, okay? That's the 10-year. Or just look up the 10-year yield. I mean, whatever. But ticker sign TNX is on TradeView, whatever. Oh, man. You got to keep an eye on that. Because if it keeps going up, even as the economy slows and the Fed cuts, it means the bond vigilantes are back in motherfucking town. And that's usually the prequel to a market riot. You dig? Third, check the market internals. Don't just look at the S&P 500 or the SPY number. Look at the market's breadth. How many stocks are actually going up versus going down? The whole rally has been carried by a few tech superstars. Meta, Google, Nvidia, Apple, Microsoft, Tesla, you name it, right? It's true though. I mean, that's a sign of weakness, not strength. Watch things like the equal weight S&P 500. Ticker sign RSP. If the main index is hitting new highs, but the equal weight one is stuck in the mud, which it has been, or falling, that's a massive warning sign that the foundation is rotten like a tomato. That's exactly what happened before the dot-com burst, and it's happening again. Finally, listen to how the Fed talks. Not just what they say, but how they say it. Because right now, they're signaling they're going to cut rates to save the weakening labor market. But if inflation stays sticky and refuses to go away, they're going to be trapped between a rock and a fucking hard place. Listen for any hesitation, any talk about inflation coming back. A Fed that's forced to choose between a fallen economy and a stubborn inflation is a Fed that's lost the plump tier. People, their confusion and flip-flopping will be the final signal that the end game is here. By watching these four things, jobs, bonds, market internals, and the Fed's own words, yeah, you stop being a passenger and you start being an observer with a fucking map in front of you. You can see the patterns for yourself and make your own moves instead of just reacting to the fucking noise. Knowledge is your armor. In the world where we're heading into, at least it is. All right, let's wrap it up. I'm sure you're sick of it. So, what you're witnessing, it ain't random. It's the end of a long, long cycle. First, you got the echoes of history, the insane valuations, the hype around new technology, and the market betting on just a few stocks. This ain't a new song, it's a remix. It's the remix, baby, of the dot-com burst. Maybe throw a little bit of '08 in there too. I don't know. Second, you got the central banks led by the Fed coming in with rate cuts. They're not the fucking saviors, okay? They're the accelerant, pouring cheap money on a fire that's already out of control, making sure the explosion is even bigger than it already fucking is. And third, you see the cracks spreading through every pillar of the financial system. The US bond market, the world's safest asset, is getting side-eyed by investors. The dollar's reign as king is being questioned. The stock market is a one-man band pretending it's an orchestra. And the crypto world is screaming, speculative forever. Fuck crypto. Seriously. It's a scam. When I sit here and I own Ethereum, I say that. Cycles, cuts, cracks. That's the setup. This ain't a forecast for a little dip or a regular bear market. I promise you that. This is the prelude to the everything or the big, beautiful bubble burst popping. A synchronized collapse in stocks, bonds, crypto, and maybe even the trust that holds up the whole US dollar and its mountain of debt. Getting ready for this doesn't mean you got to go hide in a bunker. It means you got to understand the game. It's all about the game. Stay sharp and think for yourself. I appreciate you rolling me with me on this one again. I really do. If this made any sense to you, please do me the favor. Like the video. Subscribe to the channel and share it with somebody who needs to hear this shit. And now I want to hear from you. What do you think the weakest link in the chain is right now, huh? The bond market? Those overhyped tech stocks? Or is it something else? Drop your thoughts in the comments. Let's have a real conversation about what's coming. Stay vigilant. Stay ready. Don't ask why. Just ask why not. And then remember, I made something out of nothing. Thanks for nothing. See you on the next one. Bloomberg out.
Bloomberg on the track.